Tandem's investment process seeks to remove all human emotion and bias. That allows us to be more consistent because we really just are following the math. Tandem has 3 investment strategies. We have large cap core, which has a track record going back to 1991, equity, which was started in 2007, and mid cap core, which was started in 2010. Tandem has 2 pillars. The first is to deliver a more consistent, more repeatable, and less volatile investment experience.
We believe that by limiting volatility in a client's portfolio, it allows them to remain invested throughout any market and ultimately allows them to achieve their long-term investment goals.
To do that, we seek companies that can consistently grow their earnings, their sales, and their cash flow through any sort of economic environment. A company simply either meets that criteria or it doesn't.
Our second pillar is to truly practice the art of buying low and selling high. This was once commonplace in the industry, but has sort of fallen by the wayside. And a lot of other managers pair trades, meaning they're selling a security whenever they're buying and vice versa. We view the two as totally independent investment decisions.
Buying low, in my mind, has always been easy, but you have to have cash on hand. That makes selling high a little bit harder. To sell high, you have to be committed to leaving the party early at times. And if you're committed to leaving the party early, sometimes you miss good times, but you also miss that dash for the exit.
We calculate our proprietary ratio across our investment universe of more than 3,000 individual companies. Tandem's ratio works in 2 parts. The first part is as a screen. So the screen filters out companies that don't meet Tandem's strict growth criteria. The second part of our ratio is a statistical concept, mean reversion.
Statistics tell us that most of the time things fit into a normal distribution. If a stock has deviated significantly below that long-term average, our model would suggest that it's a good time to either accumulate or add to a new position. When a stock has deviated significantly above that long-term average, our model would suggest that it's unsustainably overvalued and it's time to trim the position. Now, when a stock no longer consistently grows the metrics that we value, it must be liquidated, no questions asked. All of those decisions are just driven by math.